All right, guys, we're live.
Yes. Yes.
How you doing, bro?
Doing good, guys.
Yeah.
What are you guys up to?
Just about to do a podcast with you. That's what we're up to.
Yeah. Man. No. No. Thanks for having me on, guys. I know it's known you guys both for a while now, and looking forward to the conversation today. Let's see where it goes. And just keep it super organic, right?
Again, you know what? Like I always kind of start off like, oh, you know, the market's crazy. What are you dealing with? But before we kind of dive into that, I think I want to know a little bit more about your story, like how you got. Because you know, when you're in high school, you don't just say, hey, you know what? I want to be a mortgage agent. I don't think anybody ever does that.
Yeah.
Right.
No, that's a story on its own. So that's here. I'll give you guys my background, my backstory, real quick.
Okay.
Summarize like 10 years into here. But I think you grow up in an immigrant household, and you are either, when you say you want to do business, that to my parents means accounting, right? So that was the only thing they knew, and so as a result, I went down the entire business school route, became a CA, was working at EY, like downtown accounting firm, for like 5 years. Was grinding away at that, and in all kind of like measures within accounting, you're at like one of the top firms, and it's a good job, and all this kind of stuff. You should be pretty content and happy with life. So I started working there on my co-op terms, and I kind of knew right away, I'm like, this is like really, really fucking boring. Are we allowed to swear? I don't even know.
Yeah, go ahead, swear.
I was just like, this is really boring. Like,
yeah.
But everyone around me wanted the same job that I already had, so I'm like, there must be something wrong with me. That was my logic, and I was like, okay, I just keep going at it, and it'll get better and better. Went at it for 2-3 years. I was full-time now, and still, like, nothing was really changing. I'm like, okay, like, you can stay here for, like, 10 years and get to the entire partnership route. But then I looked at the partners and the lifestyle they were living. I'm like, that's not really what I want. A lot of them were divorced. A lot of them were working at the office until, like, 10, 11 p.m. at night. I'm like, that's not really end game for me. It doesn't really make sense.
Was this downtown?
This is downtown.
Yeah.
And so it just didn't make a lot of sense. Didn't resonate with me. And then the probabilities of even making it to partner were, like, so low, right? So that was the entire like CA and accounting journey. Now, while I was doing that, I really just started toying with different things, right? So it was more so a measure of, I was living at home with my parents, and so let's just say I was earning like 60 grand, and then my friends were earning like 30K, right? So as a result, I could go out with my friends, we could go out to eat, we could do stupid stuff, I could spend money and keep up with them while still saving money on the side. Right. It wasn't intentional saving money, it was just a result of like, I had a decent job, and like a lot of them were working part-time and so on, right? So you're kind of in this scenario where you could save money while still having fun, and you're living at home and you have no real expenses. So my dad just saw me blowing money. He's like, this kid's just wasting his money, right? Yeah. And so he's like, why don't you just go out and buy a real estate property, right? And so at that time, I got into my first condo downtown Toronto. It was a different time, 2015, 310 or something like that we bought it for. Set payment schedule. It was like $2,000 a month or something like that I kind of bought into it for. Finished paying that off within like 2 years, and then I was like, well, this isn't bad, because I saw the condo prices go up.
You finished paying off that condo in 2 years?
Not the full condo, the deposit structure, which was about like 50
Oh,
grand,
got it, okay.
Like 50, and then there was something due on occupancy. Can't remember what it was now.
Damn, you're getting good money.
Well, if you live at home, and even if you earn $5 grand a month or something like that, $4 grand a month, at that time, I really only needed like $1,000, $1,500, some food, some clothes, train. Like, I didn't really need much in life, right? It was a pretty simple life, so you just kind of put all of your income towards paying down this debt as much as possible. I had a car, sold that off. Also didn't graduate with much student debt because I did co-op terms, so like I was essentially just paying for my school as I was working, right? So kind of things set up that way. But 2017 hit, and I'd finished paying the condo off, the condo down payment off. So I was like, okay, cool, what next? And then I essentially went into Ajax, bought a property there, minimum down payment, that entire game. Rented that out, got burned pretty bad there, with like non-paying tenants, all that kind of stuff. It was a single family household. It was cash flow negative from the onset. So I was like, okay, there's got to be a better way to doing all this stuff. And so then I went on YouTube, and I guess somewhere in between here, I essentially left accounting, went into consulting, got laid off, and I'm like, okay, there's something that's got to change here, because getting laid off when you're like 27 years old, it's not that scary. You're like, I'll get another job. It's not
right. Yeah, you're living at home.
But then I would hear like my dad's like friends who were also like accountants, and they would be like 55, 60 years old, and they get laid off. Right? And I'm like, shit, like I'm already terrible with tech. Right? I'm like, I can't even do macros and like stuff like that half like my coworkers can do. I'm like, imagine I'm like 55 years old. I'm gonna be like really behind the ball game here, right? If I kind of keep up the pace that I'm going at. So I realized, okay, I gotta like build something for myself. That's really the only way to have true stability, like because I realized job stability doesn't really exist.
Right.
What's stable is what we build for ourselves.
Yeah.
So I started looking into YouTube, like different businesses, so on and so on. Found the entire real estate community there. People in the U.S., bigger pockets, talking about burning real estate. I found Matt McKeever in London, and I was like, okay, all this shit really only works in like these like random parts of like Canada and like random parts of the U.S. That was my logic at the time. And so then at that time, actually, my now wife, then girlfriend, had bought a pre-construction as well, and so we were getting ready to sell it because I also got burned with a bad tenant there as well. So we sold that one, so we had a little bit of cash under her name, and I was like, hey, like, why don't you just let me try out like a burr essentially in Toronto? Like, I'm not really sure if it's gonna work. Worst case, your money's in this property. It's not like it's going anywhere. Best case, we burn this property, I get you the money out, and then we can do other stuff with it. And so for whatever reason, my wife was just like, yeah, sure, just give it a shot and kind of see what happens. So we bought a property in Toronto, converted it, not legal, but we made it into 2 units, right? Pulled out the money. That was 2019. I'm like, shit, this stuff actually works. And this was in the GTA.
So 2019 is when you finally have that kind of realization, like this real estate thing can work.
Yeah.
And I'm going to pursue this.
Yeah, exactly. And it can be scalable. And the strategy works in Toronto. Sorry. The strategy works in Toronto, so everything was looking good. The only issue was when I did that burr in Toronto, I'd left about like $50K as a net investment in there. Okay. Right, so all in, we put about 240 or something like that into the property. We pulled out everything except for $50K, which is still really good. The house is worth about 800 grand, so I was like, $50K net investment for 800K house, pretty good, right? And the problem was, though, if I left 50K in every single property that we tried to burr, I would run out of capital really quickly. I was still only earning like 80, 90K. My wife was about the same, but it doesn't mean that you can replace 50K net investment that fast. So that's when I started. I went to a meetup, and you know, that was actually Rise. So Austin was hosting Rise back then. It was just like 5 or 10 guys.
So he was just doing that by himself, or was he doing it with a few other guys?
No, it was literally just him. He started Rise, and so McKeever had posted about it. So I was like, let me go check this thing out. I go check it out, and everyone there was talking about Windsor. I'm like, I was like, this is pretty crazy when they were talking about Windsor. And they found what I had done, because I had a condo at the Ajax house, and now we had a Toronto house, and they found that pretty cool. But I was like, my portfolio has a lot of risk because it's not really cash flow, right? And so it's not scalable if I kind of keep it up. But the numbers that they were telling me they were doing in Windsor, buying for like 150, renting it out for like 1800, I'm like, that makes a lot of sense.
Right.
So from there, I just tried, I essentially JV'd with Austin. That's how me and him met. I was a capital partner, he was an active partner. I said, look, man, I don't have time to figure out Windsor and understand why this street is way better than this other street, which is side by side. Like, just didn't make a lot of sense to me. I'm like, I can't find a realtor that's like really good. Like, I'd rather just partner with someone that's figured all this stuff out. And so I gave him the capital. I said, let's do one project together and see how it goes. We did that project together. It worked out. Pulled out all my capital plus like $5,000 or something like that. But this is like small purchase prices as well. And then I had my proof of concept. And then from there, it was, and so as part of that joint venture, I told him, hey man, I want to meet your contractors. I want to meet your realtors. I want to understand the area. We'll go to Windsor together. Yeah, I'm capital, but I don't want to be silent capital. I'd rather much be active capital, right? I'll give you the capital, but I want to learn. I want to kind of see everything that's being done.
Right.
So did all that. And then after I had the proof of concept, I'm like, okay, this thing works. Now it's just about putting fuel on the fire. So then we just started like buying up a bunch of shit. And so we would buy stuff together. We'd buy stuff with like other JV partners. And then COVID happened, and that was kind of a pretty scary time because we had something like 8 or 9 properties that had to close during that period of like you couldn't go into the banks. You had to like wait like 3 hours at the bank to get a bank draft. Like, it was freaking crazy, right? But we got through that, and as soon as we got through all those closings, it was like mid-May, and I was like, so like everything is basically on sale. Student rentals, those were like crazy discounted at that time because everyone thought for whatever reason that universities were going to be closed down. So then we just went crazy buying a bunch of student rentals in Windsor at that point. And so we, I don't know, between May and like November of 2020, we just bought a bunch of properties with a bunch of capital partners, JV partners, sometimes ourselves, sometimes different structures, whatever. The name of the game was just asset accumulation, right? In a period where things were like peak, I saw it as peak trouble, right? Like, I was like, how much lower can it get? Everyone's assuming that the universities don't open. Like, that doesn't make sense to me. Even if they don't open, I can just long-term rent this out to other people. It's like my downside is pretty limited. A lot of the stuff that I'm seeing today is kind of what we saw back then as well. So we went crazy until 2020, and then I was like, okay, now Windsor's prices don't make any sense. I'm kind of done with this, and along the way, the entire LTB risk and tenants not paying rent and that kind of stuff was just making me a little bit more cautious. And so at that point, I had 2 decisions that I saw kind of making sense. Either I go to Sudbury, or I went to New Brunswick. So I went to New Brunswick because I wanted to buy commercial apartment buildings. Commercial apartment buildings, the risk in Ontario is you don't actually know how many tenants you're going to be able to get out in order to do the burn, right? So from that perspective, I was like, well, I can't buy this property assuming I'm going to get 50% of the tenants out. Maybe it's 70%, maybe it's 20%. I don't really know how many tenants are actually going to leave here, right? Yeah. It's a big guess. How do I raise capital with that? Like, huge estimate, like you just have no control over.
Yeah.
So I started researching markets where you have more.
So let me just jump in there. So all this time while you're doing all this, did you get your mortgage license yet? Or
no?
So you were just building your portfolio. You went out to Windsor. Now you're going out to New Brunswick. Now you're going up into Sudbury. Okay.
Yeah, exactly. So
and you're doing it with Austin, or you're still doing it with joint venture?
No,
capital?
Windsor I had JV partners and Austin. Now when I'm going to New Brunswick, it was just myself. I had another partner. So what ended up happening when we went to New Brunswick is I had another partner who was looking into New Brunswick on his own already. And so we just said, hey man, like why don't we just share the active, we share the capital, we reduce our workload. Yeah. We can kind of take on more and have more scale, right? So that's what I ended up buying with him in New Brunswick. We bought a 7-plex and an 8-plex, and then that bird took about a year, but kind of executed that. So I really got my license at the end of 2020, and I didn't actively start doing it for other people until about 2021 May. And so 2021, what ends up happening is when you have a lot of projects going on, I just felt really guilty at work. So I'd left EY, I'd gone to the government. I was like, okay, this will be a chill job, 9 to 5. I need time to focus on the real estate side while I get that stuff stabilized. And I went to government. It was not chill because I guess Ontario Auditor General is part of this exempt group where you can work overtime and not get paid for it. And so the expectation was you work until 7, 8 p.m. I'm like, this is crazy. I might as well just stay in the private sector. But I had to start slacking off because I would have contractors call me during the day. I'd have I'd have to go to the bank and just do stuff. And I felt really guilty about it, to be honest with you. I was like, hopefully they let me go. They didn't let me go. I'm like, okay, I'm just going to leave. Right. And so March or April, something like that, I left government and I essentially just went, okay, I'm going to do the mortgage stuff passively. I was like, I'll do like a couple of these. And the entire objective was my end game is be a private lender. Right, like I would rather just sell everything off and just kind of move it all into private loans. That was my end game. That was my logic. And then I just started doing mortgages for people because it just got out there that, hey, am I using private loans? And then when you're doing private loans, people need to be exited out of private loans and you need to take them back into the bank side. Started doing that. And then it just kind of snowballed naturally. And it was super addicting because as real estate investors.
And now you've also built a team.
Yeah.
How big is that team right now, that mortgage
There's
team?
just 3 of us. There's another mortgage agent that I work with closely, and then there's a guy that I have on my side that helps me with fulfillment. Because the biggest part is there's a lot of paperwork and documents. Like we kind of break it down to you've got to get the mortgage accepted and by the lender, and then that's half the game, and then the other half is actually getting it funded, which is like submitting paperwork and getting all that stuff done, right?
So let me kind of just dissect all that, because that was a lot. That was a lot of information that you just threw out. So you do that. So you've got your real estate portfolio. Then you're also a mortgage agent.
Yeah.
What have you done during the time with the higher interest rates? Because I think this is a big issue that a lot of investors are having right now. Have you had to sell off some of your properties, or are you just kind of just hunkering down and holding on to it?
That's a good question, actually. We sold off a lot of properties in the last 18 months.
Why?
I'm trying to think of, I don't know exactly how many, but a lot of it was Windsor single-family houses and duplexes, the small stuff, right? And so the rationale being your biggest risk is tenant risk in Ontario, which is what happens if the tenants don't pay you rent.
Yep.
So if we get into tougher economic times, unfortunately, it's usually going to be the lower income households that are more significantly impacted, like manufacturing jobs, essentially our tenant profile, right? And so if the tenants stop paying you rent and it's one tenant, one property, then that property is now producing me $0 while I have all the liabilities for it. So we saw our single family homes as our biggest risk versus our triplexes, fourplexes, stuff like that. It was, okay, even if one tenant stops paying you rent, maybe your cash flow is gone, maybe your cash flow negative like $500 or something like that, but it's not the end of the world and it's much more manageable and tolerable, right? That was one side of it. The second is as interest rates went up, most of our mortgages were adjustable rate mortgages, so those payments went up. Cash flow is essentially gone, right? So you've got 3 forms of return in real estate, I'm sure, as you guys know, right? You've got your equity, you've got your equity pay down, you've got your appreciation, and you've got your cash flow.
Right.
Equity pay down was not happening in some of these. cash flow was not happening, and appreciation wasn't happening.
So you would say you got caught off guard?
Oh, 100%. Yeah.
Well, and the reason why I say that is I remember Austin coming out and putting a post up there saying, you know, realtors are pushing investment properties, but these rates are going to keep going up for quite some time. I remember saying he posted something along those lines. I don't know if you remember seeing that. No. And I'm like, I don't know if that's true or not. But I remember him throwing it out there.
Yeah. To be honest, though, we were still caught off guard. Like everyone. It's not like anyone.
A lot of people were.
Yeah, no one had a crystal ball for this stuff.
Yeah.
But I'm big on like, look, if these are true investment properties, there's no emotions behind any of this stuff.
Yeah.
Right. So it's just constantly look at your portfolio. What's making you money? What's not? If it's not making money, get rid of it and put it into something else that's making you money.
Yeah.
So every time we've sold, we've always bought.
Yeah. Now, let me ask you then, Chris. Did you get caught off guard as well too? Because I know you had a few properties that were locked in at the time, and a few that weren't. Did you anticipate or think that it was going to go this high?
No, I didn't. But I locked in on some things. To be honest with you, I don't even know why. I don't even know why. But I had some other plans on some other properties. I was just telling you earlier, right? Well, you guys know I had some thoughts about tearing down some properties and building some purpose-built, properties. And so I was at the architect and everything else to try to get the plans done. And then it was just about the funding.
Mm-hmm. Which, of course, then you're going to stay in a Vero because you've got to, right?
Yeah, but you know what? Right, but had I been smart, like maybe like the rest of us, I said, oh, it's okay. I'll keep it. I'll fix it. I'll lock it in, because even if the rates go up, you can always, break a fixed rate, right? 3 months interest. What does that mean?
Yeah.
So had I been smart, that's what I would have done. But I wasn't expecting that the rates would go up so fast. And then, of course, what that means is now nothing's being built. Well, we know that, developers, all types of projects. Well, we talked about this yesterday, too. All types of projects being, closed down, canceled, delayed.
Yeah.
Construction costs are expensive, and, so yada, yada, yada. So, yeah, I did. But looking back, probably should have fixed everything.
Yeah. Yeah, for sure. I know a lot of people think that same way as well too. But sorry, and so continuing on with what you did. So you took the emotions out. You started selling some of your properties. Right?
Yeah, but I also I think what you said is also a really good point there as well. Like I think a lot of construction developers are pausing things right now, which not to jump ahead in the story here, but I think that's one of the biggest opportunities today, right? It's when everyone is essentially peak fear, peak uncertainty, scared to act on anything. Like that's essentially where I think an investor can really kind of come forward. So I think that's one of the biggest opportunities in today's market. But to go back to what you were asking.
You're right, though, because there's so much fear in the market.
Yeah,
and
100%.
Yeah, and this is the time to be out there taking action.
Yeah. So I actually just have, literally yesterday, got an offer accepted on something that we're buying, but it's 2 weeks due diligence, so I'm not going to talk too much about it. But essentially, the entire game plan is it's a structure that sits within the GTA. The house is off to the side. I could just build on the side of it, and it's zoned for up to 4 floors high. Can't remember the exact meters, but it's R3 zoning, and it technically allows for 100 apartment units. The lot is way too small; it's not getting anywhere near that. But I'm like, okay, 4 floors high, and it can permit like 2 floors per apartment, two apartments per floor. That's at least 8 floors up, and maybe 1 in the basement, right? So I can put an Nineplex on it without even touching the existing structure. Because the biggest risk in development is if I have to tear this thing down, and for a moment of time, the value has dropped drastically. Right?
And where is this property?
Is it everywhere? Not yet, but it's in the GTA. I'll say it's within GTA. It's York region.
Yeah, I don't need the address.
Yeah. But I mean, from that perspective, like, there's really not much risk. I'm like, okay, like it is cash flow negative if I just keep it as it is, right? It's cash flow negative about like $1,000 per month, which is not ideal. But my intention is not to keep it as it is. But my worst case isn't terrible. Like it's tolerable for a couple of years, right? And I'm buying it based on that. And everyone's looking at this as it's got to be like a custom home redevelopment. And for whatever reason, I'm the only one that's coming in and looking at this and going, this can be multi-purpose rental, because York region, like Markham, Richmond Hill, those areas, most developers or most people that are looking at properties there aren't looking at it and going, I'm going to put a multi-family apartment there for whatever reason. But there's still a need for it. Right?
So then based on that, then where do you see the opportunities right now in the marketplace? And then also the second question is, are you seeing your clients coming in, because being a mortgage agent, are they doing what you're doing? Have you seen somebody do that? You're like, oh, I see the opportunity.
Yeah, construction lending has been big for us recently. A lot of the times.
Recently?
Yeah, recently, yeah.
Wow.
Yeah. I mean, half the time shit doesn't end up going through, right?
Yeah.
You also have some people that your existing construction lender is now jacking up the rates because they want to exit the construction loan that they're in with you, right?
Okay.
So we're oftentimes restructuring that mid-build, which is another challenge on its own, right? Mm-hmm. Projects are essentially going overages, stuff like that. That's frequently happening because construction costs are still increasing, especially with inflation, right? So the budget that you started with in 2020 versus what's ending up with in 2023 is completely different as well. So that has challenges. But to be like quite transparent, I think construction and business acquisitions are the two things that I've been talking to quite a few people about. A lot of the real estate fundamentals are easily transferred over to business fundamentals, right? It does become a lot easier if you already own real estate, right? If you already own real estate, you can access the capital there, put it into more active income producing assets. I know a couple of realtors that are even starting to transact on the business side, like selling active businesses. If you look at the baby boomer population, not to get too often in tangent, it's still about real estate, but that entire population, the average age is, I think, 67 right now or something like that for the boomers, right? So that's peak retirement age. Like, they're really looking to, like, get out of certain businesses.
What type of businesses are you seeing specifically?
Well, okay, so I'll give you a couple examples. One guy I know, I kind of talked him out of going through the acquisition, but he was essentially looking at buying a restaurant, which was, they were willing to basically transfer hands on the restaurant at net zero. It was like $20,000 net. Like, once you figure out the asset price that they were asking for, the liabilities on the business, the net price was about 20 grand difference. And they were just basically just looking to like get out of the business, right? But it does require someone that like would be more active and stuff like that. And it was a realtor that was looking to buy.
That's an active business.
100%. These are all active businesses. I think that most people are looking at it is very active. Another guy was another mortgage agent that he was just working with me for some help on his stuff, and so he went and he was looking at a couple different businesses like convenience stores, laundromats, stuff like that to kind of buy. And a lot of the times in today's world, half the time I'm negotiating myself out of a job here because I just basically tell them, hey, like go back and tell the seller you need seller financing, right? That's one of the best ways to buy a business in today's world. Right. The laundromat example, I was producing something like $25,000, $2,000 a month in net income. So I said, and they were asking for $135 or something like that.
Yeah.
So I said, just go back and say you'll pay them $30,000 a year on seller financing for 5 years.
Okay, just dive a little bit into seller financing. Somebody's listening, they don't know what that means. So seller financing, VTBs.
Yeah, it's basically the same as in real estate, right? Like businesses, real estate, whatever it is. Essentially, the seller is helping facilitate the close of the transaction, right? So the key there is the motivation level. And even this development deal that I just offered on, that was, I threw a VTB in there as well, right? Especially in today's world where people are struggling to sell. People will offer you seller financing because it gets the problem, quote unquote, off their plate and onto yours.
Yep.
And it gets you time as well, right? So.
And what type of term are you looking for? When I say term, I mean like length of time, like 2 years, 5 years, as long as you can get.
That really depends on what we're buying, right? So in my example, where I'm buying something that I want to develop, I know I don't want to develop it today. Probably within like 2 years. It's going to take me time to get the drawings, everything like that done. So we did. I asked for 200K. They gave me 150 on. I asked for 0%, they countered at 6%. But then I took that 150 and I said the first year keep it at 3% and the second year keep it at 9%. Because my entire thing is it's going to take me a year for sure to get the drawings and everything kind of approved, and hopefully somewhere between year 1 and year 2, like I'll actually start digging. So at that point I might actually just pay these guys out anyways, right? But that was me, that's my timeline, so I said 2 year there. The laundromat example, the guy wanted a private loan on another property he had to go and buy the laundromat. I said, you know, you're just kind of setting yourself up for failure, to be honest, because that's going to cost you like $900 a month, and you don't really have much income coming in, stuff like that. So then, in that case, I said, "What's the business making net income currently?" He said it was about $24,000. I said, "Okay, cool. Go back to the seller. Seller's asking for $135. Offer him $30 grand a year for the next 5 years. So your price is going up, but at least you're not taking on private debt, right? And that's at 0%, but you're offering him a higher price for a lower interest rate. So it all kind of like balances out, right? So the year and the terms for the seller financing really depend on like what is your exit, right? If like my client knows he's selling, like there's another deal out in Vancouver that we're trying to help someone with. Like they know they're going to sell their residence in like 2 to 3 years, essentially when the market picks up, because it's prime location, like multi-million-dollar house, like everything's kind of great there. And so I said, okay, even with the mortgage term that we're getting them, I'm like match it with, you know, a two-year term, so you can at least sell it with like minimal penalties, stuff like that. Right, so seller financing, everyone just thinks it's a solution to make a shitty deal work. It's not really the case, right? It's just it's got to match up with your exit, as long as you have a solid exit.
Yeah. Okay. What kind of problems are you seeing come across your desk right now on a regular basis, and then how are you helping your clients?
Yeah, I'd say The biggest one is debt consolidation. We're starting to see a lot of that. You're seeing foreclosures happen. Now, foreclosures aren't necessarily, I think they're still...
Foreclosures, power sale.
Power sale, yes.
Okay.
Yeah. But they're still at about like the 2019 level. Now, when I talk to some lawyers, what they basically tell me is a lot of it's just stuck at the courts, right? And so the courts need to do whatever they do to essentially get this property on the market. So a lot of lawyers are saying the foreclosure is higher than 2019, but the stats make it look like it's 2019 levels because the courts just haven't like processed all the paperwork.
How long does something like that take?
You're talking at least like 4 or 5 months for a lot of these things, and then a lot of the times you can kind of drag it out like.
But that's an A lender, right? Or maybe
privates. A lot of it's privates.
Oh yeah, and it takes that long still, even if it's private.
Yeah, that's what we've been seeing. The bigger, it's almost the bigger the deal as well, the longer it's taking. We had a guy come to us. I can't say the location because people could Google this stuff. Like it's publicly known. Like he was trying to build a retirement facility, 100 or 200 units or something like that. Came to me like a couple weeks before his receivership date was scheduled for like the bid date. But a project like that, like how many people are really interested in it? How easy is it going to be to even like power of sale it, right? So a lot of the time you're still trying to work with the seller. Right. The courts will kind of force you to work with them as well. But I also see like a single family house. I was looking at one in Pickering a couple of months ago, earlier this summer. It was listed for, it was by the water, it was listed for like I think $750 or something, or somewhere along that ballpark. I went in and offered $700, and the lender was like, no. And I was like, dude, you're the private lender, just like accept this and like let's move on with life, right? But he still wanted to, get paid for the 1 or 2 years. He said it took him 1 or 2 years to kind of get his situation sorted out. So it just depends on how straightforward everything is. But we're not seeing a whole lot of like bank foreclosures, because the reality is before you're going to foreclose on the bank, you will probably go on the B side, and before you foreclose on the B side, you will probably go to a private lender. Right. So private loans are really where we're seeing the biggest foreclosures, and we're seeing second position lenders just going fuck it, and just kind of walking away from their loss and like calling it a day, because the first position lender is even struggling to get paid out on their side. So the second's shit out of luck, and third position lender is even more out of luck. Yeah. Right?
So you're seeing a lot of seconds getting crushed right now, and a part of the first. On the privates.
Yeah. Okay. It ultimately depends. Like we've got a second position loan that we have out right now, and the person's struggling to pay us back. Right? It's just like credit scores have dropped, and whole slew of like issues. Right?
Yeah. Where do you see the problem was that people were just going too high in those seconds, going up to like 90-95%? You don't think were people doing that?
No. I think market values come down, and then fees stack up. Right? Like if you keep renewing, like if you renew once or twice. That 80% loan or 75% loan can easily get to like 80, 85. Like, and people are putting like heavy renewal fees, especially the first position lender. Like it's not uncommon to see an extra $15,000 as a renewal fee on like a $300,000-$400,000 loan, and then the interest rate gets jacked up too, and the borrower's just digging themselves deeper and deeper.
Yeah, and they're just bleeding up their income.
Yeah, exactly.
And that's one of the things where it's like you got to figure what is your exit strategy.
You got to
like how long are you going to do this for? How long do you hold on?
Yeah. Right. And so quite a few times people will call me and they'll be like, I'm in this loan with this MIC, and it's happened recently actually. I can't remember where his property was. I think it was Ajax. He had a $1.1 million or $1.2 million valued property, according to him, and he had like $950K as a loan on it. I'm like, dude, how did you even get this high in the loan to value? And he wanted to roll to another private lender. I'm like, man, I honestly think you should sell it, take your $200K that you've got, and like move on. Move out somewhere far, and like at least like buy, because
it's almost like it's like this pride that you've got, right?
Yeah. And he was working in trades. I'm like, man, you'll find a job. Like you can move out to Ottawa and you'll find something. You can go wherever you want, right? Yeah. But he was like, no, I think the market's gonna recover in a year. I'm like, nah, I don't want anything to do with this. Like like maybe it does, maybe it doesn't. If it does, kudos to you. You look like a genius. If it doesn't, you're now like even worse, right? And part of the thing as a mortgage broker is you got to maintain your relationship with the lenders as well, right? Because if you're putting people that shouldn't be in a product into another product, you're helping them like get deeper and deeper. It also makes you look bad, your relationship with the lender as well, right? So it's a tricky game to kind of juggle. But yeah, what I would say, to come back to the original question, like what are we seeing the most of? Definitely seeing a lot of debt consolidations. A lot of people just trying to avoid foreclosures. That's one side of things. On the investor side, a lot of investors have been burned. The people that we're seeing take action today are the people that maybe had 1 or 2 properties, because if you have a healthy income with 1 or 2 properties, you're feeling the pain a little bit, but it's manageable, it's tolerable, right? Like incomes have also gone up drastically in the last like 18 months or so for some people, depending on your industry. So they're able to buy, right? And if you're able to buy in today's market, even if it's a break even, but you're buying something that has a higher and better use in the future, whether or not you take advantage of that today is a different game, right? But you're just kind of getting into these properties.
But are you seeing investors buying right now? I mean, you've probably seen a significant drop.
100%, significant drop, but it reminds me a lot of like 2020. That's why I started off talking about that entire like COVID dilemma, where people were peak fear, but the people that bought in the next 2 years looked like geniuses. And in hindsight, it's like, oh, like you got lucky or whatever, you bought the dip, but it's like no, it required a lot of balls to like go out there and buy when like money's tight. Like I'm sure everyone right now, liquidity and capital are like extremely tight right now. Qualification is extremely challenging. So if you're buying something, for the most part, it requires getting uncomfortable, right? Like, are you going on the B side when you've traditionally always been an A side lender, right? And if you are, like, yeah, it sucks for a year, 2 years, whatever it is, until you need to have a game plan to like get you back on the bank side, right? But it requires getting a little bit uncomfortable. But the people that are doing it are, for the most part, being rewarded with really good deals, right? Like you're able to, like what I just did, a 2 weeks due diligence on a deal in like York Region, which you would never be able to do. Mm-hmm. Seller financing on a deal, like no way. Like people would have laughed at me like a year ago, like 2 years ago, right? But I'm able to throw it out, and then I'm able to use those 2 weeks to figure out, okay, like how can I take this down? Like I'm able to actually talk to the city, like talk to the planners, verify that I can do the bill that I wanted to, right?
Yeah. And you know what though, as tough as it is for a lot of people that are going through this right now, I guarantee you're going to see some of those investors over the last year, 2 years, they're gone. They're never going to come back. This is almost like a cleansing of the market, which allows you now, who's maybe a little more sophisticated or other sophisticated investors, to kind of get back into the market and really kind of now start taking a look at things. Like fear is a good thing in the marketplace. When there's no fear, that's when you make bad decisions.
I agree. I'm luckily, like, we got way too busy in the mortgage world, as I'm sure you did as realtors as well, in the peak of the market. So for better or for worse, we just didn't have time to buy our own real estate. Like I was telling someone else yesterday, I'm like, I honestly just got lucky, man. Like I think I would have bought if I had time to like go on like deal hunt. But we didn't have time to deal hunt, and so as a result, when the active business is really good, we were like all focused on that. And now the mortgage world, like similar to real estate as a whole, it has slowed down a decent amount, right? But the result is you actually have time to now spend on the investing side again, right? So for better or for worse, it is what it is, right? But you kind of just have to see the biggest opportunity.
That's a good point. So at the time, you were working more like on your active income. Yeah. Now you're actually working on your wealth building. Yeah. The side of it, right?
Yeah, because there's always going to be like ups and downs. And I know like things will pick up at some point again. And when they pick up again, I'll just kind of go back to focusing on that. But like I'm sure you guys have kind of found different things to do with your time as well. It's like you actually have time to like try out different marketing strategies. Like I really want to have a newsletter for a long time, and I mean, I still haven't launched it, but it's in the works for like the next couple of months, right? So I think that's what everyone should be doing, right?
Yeah, absolutely. That's what we did. I mean, look, like I was still very busy this year, doing completely different things. Yeah, not as busy as I was the previous year, doing more active income, right? And it's just putting in more time on refining some of the systems and putting things in place and processes, right? Like, what do you find? Same thing for you, right?
Yeah, I find the same thing. I mean, again, the active stuff isn't so active. So I'm looking at other things. Well, I was just telling you earlier, right? I'm looking at a property right now. Yeah. Well, I'm just thinking down the road, right? And then I've got other things in the works too. But again, it's just thinking down the road, because not last year, the year before, and I guess last year, it was busy. I was stressed out, man. Yeah. Making money gets you stressed out.
That's a different problem.
Right? Right. It's just a different problem.
And you're making sure that you're properly protecting your clients, and you're making sure you're reading all the like you got all this paperwork coming in.
Yeah. I mean, obviously, at the end of the day, our job is the clients. Our job is to work with the clients. It's just we happen to get paid to help people do what they want to do. Yeah. Right. Or to help people. I guess think about themselves down the road, right? At the end of the day, as investors, right? Yeah. This is all about wealth. So, yeah, you get really busy, and things come along with it.
Yeah. Are you seeing the banks starting to bend some rules? Can you even talk about that?
I thought they were getting more strict.
Yeah, last year was the worst. Last year they were.
Well, you also guys had the big the CBC marketplace. whole episode
Yeah,
come out,
entire-
right?
on the
Right?
entire mortgage industry.
On the mortgage industry. So
Yeah.
that really hurt the rep a little bit.
Yeah, for sure. I think last year every lender was looking at what excuse do I have to
say no.
say no,
Yeah.
but like not like say no even when it meets my policy.
Wasn't Scotiabank also for a time they were making they had a pause or slowdown? I think they brought in a new CEO, right?
Mm-hmm. Yeah, exactly. The executive team completely changed up.
Right,
over
and then
the
they
last
said,
year.
"Oh, we're going to slow down on the investor market."
Yeah.
Right.
Yeah.
And so,
But I can't really delve into everything, but like, you know, I've got some people that we talk to about this kind of stuff, and essentially the mortgage business for a lot of these banks is not largely profitable on its own, right? It's, you're getting them on the mortgage business because it's a necessity, and it still has to be profitable, but some of these banks were actually losing money in 2021 and stuff like that. Every mortgage they would do would essentially cost them a little bit more.
is that why they keep pushing credit cards at me?
Yeah, so that's what they
Yeah,
try to
yeah,
do
yeah.
now.
There's your lead, right? There's your loss leader, and then it's credit cards, and then it's other things, line of credits, and
Yeah.
other things, right?
Yeah.
So if you look at Scotia specifically now, they actually have completely just accepted it, and they've gone, this is your rate if you just want a mortgage, but hey, if you come and you open a checking account, make sure your payment comes
Yes.
through here and get an additional product, whether it's a credit card, line of credit, whatever it is, we'll give you, like, call it 0.15 off.
Yeah, or if you come in and you put some money in the account and you get a credit card, well, we're going to give you $400, $1,000, whatever, bonus.
Yeah.
Right? See
Yeah.
that all the time.
Total net worth programs, those are increasing in popularity. TD for a long time was just completely uncompetitive, and they started saying, hey, if you've got a total net worth over 250 and X, Y, and Z, like, we'll start to make all these exceptions, and we'll let you go to 60% on the TDS, UDS, stuff like that, right?
Yeah.
So there's definitely there's been a lot of changes, I'd say, on the banking side. The exceptions that we used to get, we're not getting, but now we're getting completely different exceptions, right? So it's just about, like, where do you fit in as a client. I would say the biggest thing that everyone has to accept is a lot of times you are a B-side client today if you used to be like an A-side client. Right? Unless you were like qualifying, no problem, I earned $300K and I'm buying a $500K house, right? Like if that was you before, then you're still fine. But if you were kind of like on the upper end of your ratios back when the market in 2021 was what it was, and we kind of had to, play around to follow position a certain way to make it work, well, you're definitely on the B side today, right?
Right.
And so but the B side has been so like
It's been pretty close in rates, right?
exactly, yeah.
Yeah, so it's actually pretty attractive.
Exactly. And I was going to say, there's such a big negative stereotype about the B side.
Yeah, it makes you feel dirty. Ugh.
Yeah. It's because like the B side, there's three types of people that go there. One is like self-employed individuals like ourselves,
Yes.
right? The reality is you've got two choices: either pay more in taxes or pay more in financing, right? The second is like if you have slightly extended ratios, right? So that's where a lot of people are going on the B side now. And then the third is if you've got a messed up credit score, like under 650 and below, right? So where the B side really starts to get more expensive is if you have bruised credit. There's almost a scale to this stuff. If you're self-employed on the B side, you're getting some of the best rates, usually about like a 0.3, 0.4 higher than the bank. Not terrible, right? If you're extended ratios, okay, cool, you're a little bit more risky, right? Because the reality is on the B side, they understand the game that like the B side is just that self-employed individuals just don't report as much tax. That's not necessarily more risk,
Right.
right? It's just a way that you report taxes, right?
Right.
But extended ratios, that's a little bit more risky, right? And now if you have a bruised credit, like a credit score of 550, well, now you're definitely riskier. So that's where you see, like, if you've got a credit score of 550, be ready to pay like a percent and a half higher than the banks. But if you're just self-employed, it's like a 0.3, 0.4, like it's not a drastic difference. The main difference is, there's a 1% lender fee.
And then the
on
fees,
B side.
yes.
Okay.
That's the thing.
I want to switch gears a little bit. What do you see coming down the pipeline from, say, OFC for next year or even this year? I'm sure you must be hearing some things that are happening.
Yeah.
And I'm going down this path right now because where do we go next year? Are we lowering interest rates? Are we extending amortization? They've got to be looking at all this stuff.
Yeah. Okay. So really the reason. Okay. So OSFI last year had rolled out all these proposed changes. There was the debt service coverage ratio changes, debt to income changes, all the stuff that basically got squashed in public consultation. I think it was October. Coming out of October, the ending proposed changes that seemed like they were still going to go through is the HELOCs coming down to 65%.
Really?
But that's really.
Hold on, that is coming.
Yeah, that's basically already been rolled out. I don't know if you guys have a bunch of like Scotia products. They sent out a bunch of letters in the last like month or so, basically saying that. But it's really impacting that product the Scotia step. You guys have that?
Yeah. So what so this would be for new mortgages. So if I already have.
Yeah, they're talking about winding it down.
Yeah.
Like as you pay down your mortgage now, the amount of HELOC that will increasingly become available will get smaller and smaller and smaller.
So and that happened, I think, back in the late '80s, early '90s.
Yeah,
they did that.
And they're basically saying, like, I mean, to be fair, you could never get a HELOC above 60. If you just went into bank, had a paid off property, and you tried getting a HELOC, you're limited to 65%.
So
if it was paid off, though, that's an important point.
Yeah, but so what's the difference then? What's
the difference is that you now can go, or last year you could go into the bank, you could get a mortgage for 60% of the value of your property, and then get a HELOC for the remaining 20%. Mm-hmm. Really, the loophole that they're really closing is you used to be able to go into the bank, get an 80% loan to value mortgage, pay it off in a year, and you would now have an 80% HELOC.
Okay,
right? But you would never be able to go into the bank and just get an 80% HELOC if you did that from the get.
But how could you get an 80% HELOC? They always capped it at 65.
Because you get a mortgage first and then you pay it off.
And that's the trick.
And with the step, whatever you pay off becomes a HELOC.
Oh, I understand.
So now what are they closing?
They're essentially closing. They're saying no, like as you pay off a mortgage, like it's got to come down to 65%.
Okay, so that's a small.
But that's not most people.
Yeah, exactly. Right? It's not most people.
Yeah, that would be like a small percentage of people that would go ahead and just, hey, let me get this 80% mortgage, pay it off, and I got an 80% HELOC.
Yeah, exactly. So I think a lot of these proposed changes are over glamorized, right? The other one was if you had an insured mortgage, because the entire concern is on renewal. Usually, it's been very competitive. The banks will give you the lowest rate on renewal because they have no commissions, they have nothing to pay out. You are their existing client. Right. But what happens when the banks realize, like, Mayu can't go anywhere else because he doesn't qualify anymore for the exact mortgage that he already has?
Right.
I don't need to be as competitive because he literally cannot leave me, right?
Sure.
So the entire concern was, as we get into 24, 25, 26, where I think about 60% of the mortgages up there are coming up for renewal in the next 2 to 3 years, right? Mm-hmm. What essentially happens to the competitiveness of renewals? So OSFI's just said, hey, like, if you have an insured mortgage, apparently this is always the case and no one ever knew it and OSFI never publicly said it, then you can essentially qualify at the existing rate. So they took out stress tests for renewals of insured mortgages. A very small niche, but it allows people to be more competitive and kind of rate shop a little bit more, right? They haven't said anything about like us.
So you can qualify at the existing rate?
At the contract rate.
At the contract rate?
On renewal.
Okay.
Going from, like, let's just say you have a Scotia mortgage and you're like, I want to shop this, I'm up for renewal. Mm-hmm. If you had to qualify at stress test, you might not be able to qualify. But they're saying if you're insured, then you can just qualify at the contract rate with a different lender, right? So it just makes it a little bit easier to rate shop.
Yeah.
Right? That's another proposed change that we'll see what kind of happens with it. Don't really know where to go if it kind of gets applied to rental properties and people that did 20% down. Stuff like that is what people are asking for. Whether or not it actually happens, we'll see.
Well, here's the bigger issue, though, right? Because I think you know this as well, too, is that there's a lot of mortgages out there right now where their amortization is now at 60, 70, 90 years, and their payments haven't changed.
Yeah.
Okay. There's got to be a huge concern there.
100%.
Right?
Yeah.
Yeah, I mean...
Right. So what are they...
What are they proposing for that?
Exactly. Because are they going to keep those amortizations there? No.
No. Yeah.
Right.
The short answer is nothing right now.
So we don't know.
Right? Yeah, exactly. We don't know. I was reading something yesterday about how to come back to the same payment, you'd have to have rates back to 0.25, right? Like essentially because your mortgage is growing, right? Over the, let's say you have 2 years of actually paying down your mortgage.
You have to have the rate back down to
0.25.
0.25.
Yeah,
the bank rate.
The bank rate.
Yeah, that's never going to happen.
It's never going to happen, exactly. So what ends up happening, we don't really know, right? Like as of right now, hasn't really been much communication on extended amortizations beyond the 30 years that they've been offering. Obviously, the B side has it and the B side does it, right? But other than that, the main thing that we're doing right now is if you've had a 30-year amortization and you've paid it off for 5 years now, and people are coming up for renewal in 2024. Instead of doing a normal renewal, we are refinancing, which just means we're stretching it back out over 30 years. It's not perfect. It obviously doesn't completely offset it, but it helps, right? It's like, okay, you at least don't feel the full impact. Instead of your payment doubling, maybe it's like 1.4 times as much as what it was before, right? People that were on insured mortgages that had a 25-year AM, like we're kicking it back out fully to like 30, right? those kind of changes makes it a little bit more affordable. But that, I think, is also a big part of the reason why, if you look at the yield curve, they are expecting like rates will come down next year at some point. If it's not next year, maybe it's 2025, right? Because there's more and more people. We as investors, we kind of have the short end of this. I talk to my friends that are investors, and they're complaining about inflation, cost of living, and stuff like that, and they're in a fixed rate mortgage. I'm like, dude, my mortgage has gone up from $2,600 to freaking $4,700 a month, and that's on my primary residence, let alone everything else, right? So we've been feeling the impact of this, but a lot of people are just feeling the impact of groceries and gas and car payments and stuff like that.
That's true.
They're not feeling the full impact of it. That full impact will probably come 24, 25, 26, right? So as it's starting to be felt, it builds up the case that, okay, rate cuts might actually start to happen, right? And so that's why they're pricing in more.
Yeah, and they're going, again, I'll go out on a limb here, they're going to have to happen. There's only two things that can't happen. They have to lower the rates or they have to extend the amortization. Because, again, they don't want these homes. The banks are not going to take possession of all these properties, right? So they've got to do something, right, to help. So yes, some of these families will get caught, some of these investors will get caught, but not everybody. They will do something.
I would hope so.
it'd be blood in the streets.
Yeah, I think the biggest risk economically, if we kind of talk about that a little bit, is unemployment, right? I think, unemployment right now is actually sitting at about a historical average. It's not too crazy. I was looking at the graphics. I was preparing this deck or something yesterday. I was looking into all this stuff.
Yeah, what is it at right now?
It's just under 6, I believe, 6%.
Yeah, it's like 5.7.
5 points. Yeah, 5.7. It's been going up 0.1, 0.1, 0.1 for the last couple of months, 0.2 or somewhere in there. But it's not like historically, like it's still in line with historical averages. The problem is like wages aren't necessarily going up, right? And we got used to 2021 where unemployment was at like an all-time low, right? And that's where wages were like jumping like crazy and so on and so on. So now you're seeing less job postings, less promotions, and wages just aren't tracking up as much and stuff like that, right? So, where do things kind of go from here? We don't really know, but essentially if unemployment continues to go up, that's where I think you've got the biggest risk, right?
Yeah, so there's two more rate announcements, well, almost two more, but anyway, before a break. So there's one in December, one in January, and then they pause in Feb, right?
Yeah.
What are your predictions for those two?
I think we're going to stay where we are. That seems to be what the market, but it was crazy leading up to the October rate announcement. I think the first 2 weeks or something like that after the September announcement was, we're definitely going to see a hike, right? And then things changed really quickly.
It did look that way.
Yeah. And things changed really quickly just because inflation had kind of came in around where like staying kind of stagnant, right? And then unemployment had come in like tricking upwards. GDP had come in essentially 0% is negative as far as I'm concerned, right? So it really just what happens with these other variables is ultimately what's going to impact the rate announcement. But kind of with what everyone's seeing, unemployment tricking upwards, GDP essentially staying flat, those two alone is enough to probably just result in a rate announcement just kind of being a hold, right? If those variables start drastically getting worse, like if GDP starts becoming like increasingly negative, that builds up the case for a rate cut, right? But right now the market seems to be pricing that in Q2, Q3 of next year. We'll really see what happens. Like ultimately, we were talking about this right before we started. None of us really know, right?
That's the thing, right?
Yeah. But hold on. When we say rate cut, I think everybody gets the impression that it's going to be 2%, right? So something like that. So when you say rate cut, what do you mean?
0.25.
Right. Okay.
Like max of 0.5, but that would be kind of crazy.
Yeah. But I'm just saying because
that would be crazy.
The perception is, oh wow, rate cut. I'm waiting for that 2024, 2025. Yeah, they're going to cut it by 2%, right? No, they're not going to do that, right?
Yeah, and it's true. The answer, like the fixed rate mortgage, that entire debate of like what is the right term and like should we take a 1 year, 2 year, 3 year, 5 year, stuff like that. The answer is usually you take the lowest rate that's available to you. So right now that is a 5 year because all these terms have everything like completely priced in. A 5 year that you get at 5.8 versus a 3 year you get at 6.5. You're paying 0.7 more for the first 3 years, right? Just for the potential last 2 years of maybe paying a little bit less, right? So the point is like the interest rate market is a perfect market. Everything is priced in. It's kind of like the stock market where everything is in perfect equilibrium, right? Like in theory, there shouldn't be any stocks that are actually undervalued versus overvalued because you've got a mass amount of buyers that are buying into this market and everything trades at equilibrium.
So what can you get a 5 year at right now?
5.8.
5.8 for who? To who?
It's insured mortgages, though.
There you go.
Right?
There you
Yeah.
go. Okay.
Not rental.
Not rental.
We're all paying premium stuff anyways.
Okay. And yeah, insured mortgage. Right?
Yeah, and like with like a TD.
Even 5.8, I'm surprised.
I haven't been able to qualify with TD for years, right? So like, it's not realistic for some of us, but
yeah. If you were to go back and take a look at everything that's happened to where we are now, right at the beginning of it all, what would you have done different if you were at the Bank of Canada? Where did they mess up?
I think that's way above my pay grade. But reality is, you put way too much money into the economy. That goes back to 2020 and 2021. Someone asked me, not to get into the entire like drama that was back in 2020 and all that kind of stuff, but someone asked me like, what was the solution? And I understand, paying people for a couple months to kind of sit at home and stuff like that, but forcing people to stay at home, right, and kind of just mass funding a lot of people, like just giving it on scale at the rate they did, was essentially what has led us to where we are today, right? Yeah. The business loans, everything that kind of all kind of pieced together to so much money entering into the market, right? People were working 2 jobs like it was nothing. I had clients that had 2 full-time jobs, 80K here, 100K here, 180K combined income. Right, and now that you're going back into work, you can't continue to do the same thing. It was just
raining.
It was raining. Yeah, people were
my phone would not stop ringing.
Yeah,
it was just like everybody wanted to be a real estate investor. It was just wild.
Yeah, I mean the real estate economy is one side of it, right? Like the other side, like because this was literally I was also listening to yesterday. It was just like I didn't even realize like how many people had 2 jobs. I had clients that would come to me with 2 jobs and like, can we use this? I'm like, yeah, you can. Mm-hmm. And I was always amazed that they had these 2 jobs, and one guy had 3 jobs. It was crazy. And he was earning combined like 330, but the reality is now that we're going back into the office, you can't have those 2 jobs anymore. Right. You're gonna get this.
Right.
And so now you've got.
So he's virtual.
Yeah.
He's got like 3 computers.
Yeah,
going.
That's exactly what they did. Wow. I had one guy who had, it was him and his 2 cousins, and between them they had like 5 or 6 jobs. It was like you can like crazy. Always like take turns, and you're all in a room together and just doing this crazy stuff. So yeah, like the printing of money had essentially increased the money supply like quite drastically, right? And now all we're doing is just taking that money supply back out of the market.
Yeah. Another mistake they made as well, I don't remember what month it was. I think it was January. Yeah, it would have been January. And the rate announcement came out and they did nothing. And remember those homes are going up like 10, 20,000 a week. Mm-hmm. It was just crazy. And I'm like, oh, they're going to raise rates for sure. And they didn't. And then we went right into the spring market. So February, there was no rate announcement. Okay. And then March came along. And we're like, this is crazy. How did they miss that one? I think you guys, you don't remember that? It was,
it was also the messaging, I think, that had come through, right? Which is we're not going to increase hikes or we're not going to increase rates for
a long time, right?
Yeah. For a long time. Didn't he say a year? I'm pretty sure he said a year, 2023.
What did he say?
I think he said that interest rates are going to stay low for a very long time. So if you're looking to buy your home or if you're looking to put money into your business, go ahead. Okay. And I don't remember now. I have to go back and I should probably fact check this. And I'm pretty sure he said 2023. Rates were going to stay low until 2023. Oh, right. Okay. And then people went out and they bought investment properties and they put a lot of money into their business.
Yeah. And they did the cottage thing.
Yeah.
Yeah, I think the lack of transparency is essentially what caught a lot of people off guard, and I also think that's what's gonna.
Yeah, but that's right now the lack of transparency is what they're hoping for, right? I mean, the uncertainty is what I'm saying, right? Lack of transparency, uncertainty. They don't want you to kind of know their next move, right? Because that's kind of keeping things at bay, and that's what I said. They don't even have to announce a rate hike. Yeah. They just have to say, hey, we might do a rate hike.
We're keeping it open to it. Yeah.
Yeah. And then like I was saying yesterday, you give a kid a stern look, you don't have to do too much. Yeah. Curbs behavior. Yeah. Right? Just a stern look.
Yeah, so I'm just going back taking a look at this. So Bank of Canada sees rates on hold until 2023 in a policy statement Wednesday, officials led by Governor Tiff McClellan. So they said it. They actually put 2023.
Yeah, but when he said a long time, and I remember I was listening to the radio just was it last week, 2 weeks ago or something like that, and he was on. This is CBC, and he was on, and he was asked about that statement. Rates will stay low for a long time, but a long time. There's no definite time frame. So a long time could be 6 months.
Yeah, but that's why I said that though, because he did say 2023.
But it was also when inflation started happening, and they said, "Hey, this is all transitory, and we're not too concerned with inflation and stuff like that." And then the complete switch up later of we have to increase rates to combat inflation.
Oh, okay, hold on, let me change it. So he said they will likely keep it there until 2023.
Okay,
so
but
likely is the key word.
yeah, but okay, but listen, here's the reality. He's just a guy.
Yeah.
He's got a bunch of advisors. Everybody got it wrong.
Yeah.
So what makes it that he could have gotten it right? You know, no
It's
defense.
not that he could have gotten it right or wrong. He could have said, "Hey, look, things are starting to get a little bit out of control. You may want to consider locking in or whatever."
No, but the problem is as soon as they do that, you said the market's already priced in, right?
Mm-hmm.
All the stuff is priced in. So immediately, had he said something like that, then now the bond goes up, right? So all the, like the fixed rates, all the fixed rates start to go up because whoa, you're going to be starting to lock in, and he just made that announcement. So that's I thought the same
thing. I
thing.
hear what you say. So they did it that way, knowing that some people were going to get caught in that.
Yeah, but again, listen. He's one guy.
Yeah.
No defense on him or anybody else. But I'm just saying he's just one guy, and he happens to be the face. Mm-hmm. I bet you. You think he goes home every night, with a smile on his face, back to the wife? Hey, honey, this is what I did. I'm pretty sure you can't sleep at night, right?
That's fair.
Right, but at the end of the day, I get it. They really what I believe is that they started this whole process too late. I think is
of
really tightening.
Yes,
I think that's
sure. That January was the wrong message that they sent out to Canadians because they had now 2 months of people just going crazy.
They should have been in 2021, like mid 2021 is when they should have started,
or even late. Yeah, you're right.
The problem was
just a bit,
locking down in 2021, right? Which then added challenges. You still have to keep giving out money in 2021, right? Mm-hmm. But I also think there were some things that were just beyond the control of anyone, right? Because ultimately this is global, right? No one country can.
This is global.
If you're like a developed country, no one developed country can deviate too much from the course of action that essentially is led by the U.S. Right?
So I kind of want to wrap it up with this, and just at a high level, macroeconomics kind of view. What are you looking at? What are you paying attention to? We're kind of sitting in some places. Maybe people say, kind of the brink of war. They're kind of keeping an eye on it. Does that kind of screw things up with supply chains? Like, what are you paying attention to, or maybe even who are some of the people that you listen to at that high level?
That's a really good question. I think the easiest approach for most people to kind of get these economic updates is just go straight to the bank's forecast reports and the market reports, right? Like that's the one thing that I essentially just actually consume. The rest of it is honestly the media just taking segments of whatever could be like newsworthy like headlines and kind of like marketing that out, right? Okay. It's like if we were to have some sort of catchy headline today for the podcast, like because it gets views and stuff like that all makes sense. But if you go straight to the source data, which is I track unemployment rate for Canada. I track inflation. I want to understand what parts of inflation are going up, because if it's like food and groceries or whatever, right? That for the most part is led by the war in Russia and Ukraine, right? Because you got your wheat prices and stuff like that. So you got to understand that side, like what is leading to inflation going up. If it's shelter, I'm actually like, that's not terrible, because that is self-inflicted pain. Like our interest rate is going up, and as a result, our shelter costs are going up. So you want to understand where in inflation, like what's happening there. You want to understand what's going on with the unemployment rate, and then you want to monitor the GDP. That's on a Canada-wide level. Yeah. On a global level, it's almost there's no point really trying to because I went down an entire rabbit hole trying to understand the impacts of Russia, Ukraine, Israel, and all that kind of stuff that's going on in the Middle East, right? But it's an entire rabbit hole. Like you could just keep digging, and I just realized it's toxic for myself. So I just kind of went, you know what?
That's a good
enough
point.
Is enough, right?
Yeah.
And then it just comes down to like, what are you going to do with knowing all this stuff, right? So it comes back to understanding your own capital, your own liquidity, your own qualification, and then take action at a pace that you're comfortable with, right? Like I bought 2 properties last year, and I went, I'm pretty happy with this. One was a cottage, one was a triplex, right? But it was like peak uncertainty, wasn't really sure. This year I bought a 7-plex in the summer because I was like, okay, like this works regardless of what happens to the market, right? And this development deal, if it closes, is going to close next year in January. And I'm like, okay, like I'm pretty comfortable with the cash flow negative position on this. I can develop it whenever I want. And you kind of are thinking about your capital, your liquidity, how am I going to qualify, what's the exit, do I have multiple exits, right? But you got to do it at a rate that you're comfortable with. I'm not buying at the same rate that we bought in 2020 because the market then was a different opportunity than the market today.
Yeah,
right?
That's good advice. So don't go too deep down rabbit holes. Pay attention to some things that you can kind of control, and then do things that allow you to sleep at night.
Yeah.
Right. And you know, and that's so true, because I know when I was taking massive action back in 2011, 12, 13, I didn't have as much data as I have now. And I think sometimes when you have too much data, it actually puts you in a state of fear.
Yeah.
That's the whole thing of analysis paralysis. You start looking at everything like as if I can control the wars that are happening in the world. I have zero control of that stuff.
It's true, right? It's true, because you just said it. Yeah, you look at the data, and then what are you going to do with it?
Yeah.
Right. Honestly, what are you going to do with it?
Right. Yeah, so you still take a look at the kind of surface level and say, okay, cool, this makes sense. Hey, there's not a lot of buyers in the market right now. Time for me to go out there, take some action, and maybe potentially pick up some deals.
Exactly. Yeah, you can throw out offers. You can it's the best time to have a little bit of capital, have the ability to take action. You're in a really strong position as long as you're reasonable with what you're trying to buy.
I like that. That's a great way to end this podcast. Great message. If people want to learn more about you and reach out to you, how do they do that?
Yeah,
the best way?
The best approach is honestly Instagram, mayu.thava, mayu.thava. That's where I produce content. You can shoot me a DM there and kind of jump on a call from there.
Awesome. Mayu, thank you very much.
Yeah,
Chris,
appreciate it.
thanks for jumping in as well, too, and doing this. It was fun.
Good.
Awesome, guys. Beauty.
All right.
All right, guys.